Just break down the basics here. Why do investors flock to gold in times of uncertainty?
There's two types of plays here. One is that investors that might be long equities, and we're paring those back leading into as the crisis in the Ukraine escalated. They look at gold as a safe haven relative to putting it into cash. So it's a really hard asset versus fiat currency. The other thing is there's speculators or short-term traders that are buying gold or gold derivatives, expecting the first group of investors to buy gold.
Okay. All right, interesting. And John, let's bring you in. With all this uncertainty in Crimea, it appears that Russian troops are on the ground, certainly Russian warships now in the port and jets in the air. What's your trade on gold?
Well, our sense is that gold is probably bottoming out and establishing a range, but it's going to have further upside in the very short term. You know, we put in a high last September right around $1,425 an ounce. And between softer economic data affected by the weather here domestically, as well as geopolitical tension, we kind of have a sense that gold can probably challenge $1,400 to $1,425 in the not-so-distant future.
All right, and so for those of you who perhaps don't understand futures so well, let me explain to you this trade in real terms. The price of gold is quoted in dollars per troy ounce, but each futures contract is for 100 ounces. So right now, gold trading about $13.50 per ounce. If it rallies above to $14.28 per ounce, then that's a profit of $78 per ounce. But since the entire contract is for 100 ounces, if that rally happens, you'd make about $7,800 for every contract you bought at that level. So, Greg, there's a lot of lingo also that futures trade. Starting with the spot month, or the spot delivery month. What's that?
Sure. The spot month or a spot transaction is where the seller has to deliver the commodity to the buyer in 1 or 2 days. And generally in the futures market, we refer to the futures or the front month contract. And that's the futures contract that has the closest delivery date to today's date. So in gold, for example, the front month contract is April, which is the most active, meaning it has the most volume, and the most open interest, meaning it has the most open contracts. That makes it the most liquid. So investors need to really be focused on that contract for the liquidity purposes. So you can get out when you want to, or get out if you're wrong, and get out at the price you want to get out at.
All right, great. And let's just bring you back in, John, for a second. What do you think is sort of the next, just to kick this forward a little bit, what do you think is the next big event that you think could impact the price of gold?
Well, I think positioning has reflected that retail got out of gold following the 2012 sell-off. And thus, we think that if there's a risk to gold going even higher than, let's say, 1,400, it would be that the softer economic data we've seen here in the United States carries on after the weather's warmed up. Gold would then reprice to maybe $1,450, maybe even $1,500 an ounce.